SeekingAlpha report comparing cybersecurity stocks.
Report that I mentioned, as you can see, I'm comparing several security stocks here: Palo Alto Networks, Fortinet, Cloudflare, Zscaler, CrowdStrike, and Okta. And I like to look at this because it's a nice snapshot and a nice comparison. So here we know the market cap of each company. We know how many analysts are following them. I like to look at this, and I usually like when fewer analysts are following them. And here we have some ratings. This quant rating is some secret sauce calculations that is proprietary to SeekingAlpha, and based on some quantitative metrics, they rank. If the stock is bullish or if they're neutral. This is SeekingAlpha authors rating, and this is Wall Street analysts ratings. So you can see Palo Alto Networks has very bullish rating from Wall Street analysts, and SeekingAlpha rating is bullish. But in general, look at this. Everybody's quite bullish on all of these stocks. So this is some interesting information. I like to look at this, and here you can see on value they're all red. This is quite natural because these are growth stocks, not value stocks. And even in growth, Zscaler has an A+ rating. On profitability, Cloudflare is doing very poorly, but Fortinet, you can see, has both momentum and profitability. Trading, this is just telling you what the price was compared to what was the 52-week high, what was the 52-week low, and what's the difference. So I like to look at this to see if I'm buying today, am I buying it cheap compared to its highs and lows. So for example, Zscaler is nearly 22% below its highest price. So is it a bargain? I don't know. But then we look at if the price, how does the price compare to its lowest, 52-week lowest? And here, Cloudflare, the current price is already 273% above its lowest price. So am I buying? Is it still too expensive? I don't know. I like to look at this also. These are total returns. It tells you monthly return, yearly returns. For example, if you look at 3-year return, Palo Alto Networks had an 80% return. Fortinet 262%, Zscaler 555%, Okta 461. I mean, these are huge returns. So as you can see, the older the company is, the harder it gets to keep giving massive returns. Still, Palo Alto Networks gave almost 80% in the last 1 year, which is phenomenal. Fortinet had 100%. Brilliant. Cloudflare 268%. So again, these look like very strong stocks. None of them give dividends, and here we have valuation. I'm not going to spend too much time on these. I like to obviously look at the growth. How are they growing? Cloudflare grew 50% in revenue. Brilliant. CrowdStrike 81%, brilliant. But again, CrowdStrike is, I think, one of the youngest in this cohort. EBITDA growth, again, so this is not good. Cloudflare has no EBITDA growth, which means it is not profitable yet. So these, again, I like to look at these numbers, and then profitability. What's the gross margin, EBIT margin, and you see here, Cloudflare is negative. Fortinet is profitable. I like profitable companies. What else can we look here? Momentum. This is price momentum. Again, I like to just look to see where the hidden stocks are. Like, even though Cloudflare is not positive, the momentum is on their side, which means the wind is in their sails. EPS revisions, and these are very important, the income statement, balance sheet, and cash flow. And Palo Alto Networks, Fortinet, all had huge revenues in billions. Cloudflare has the lowest revenues compared to this cohort. But this is what, look at this. Palo Alto Network had 3.78 billion in revenue, but net income is minus 368 million, which means overall, even though they may be EBITDA profitable, they are not profitable at the net income level. But Fortinet is. It's really profitable, this company. So yeah, look at these, and then I like to look at the balance sheet also. We need a strong balance sheet. Here what I look at is the debt to equity, and I like that Cloudflare is not burdened with debt. I mean, Palo Alto Networks, 334% debt to equity. That is scary for me. Okta also has very high debt. Debt to free cash flow, this is also important here. Cloudflare fails because, again, they are not profitable, so they do not have free cash flow. I like free cash flow. But, debt is, for example, Zscalers, they have 4.3 times debt compared to free cash flow. So I'm not sure here who is stronger, even though revenues are huge and cash positions are huge. The debt burden is also huge on most of these companies. And that's normal for growth companies. And since the since the interest rates are so low these days, it's easier for companies to take debt.
As you can see, it's not easy to pick a stock. Indexes will do much better for most of us. But if you do decide to pick stocks, make sure you look at the financial statements and other metrics that I've covered here. Good luck!